Okay, so the idea here is we want to be as efficient as possible with bookkeeping. None of you started a business so that you could do bookkeeping, and neither did I. So I can relate to you on that front. And but it's important and it needs to be done. And so we'll talk about kind of how to do it effectively and efficiently. Jumping in, first off, just making the comment that like genuinely this is something that it is critical to do good record keeping and have financial control. What I have seen over and over again, and honestly, any of you could find similar stories out there of people who have been really successful at selling, and then they forget to do all the other stuff. And so a lot of times it's this boring stuff that is what actually allows for financial success and for wealth. And that is certainly the case for, what we're talking about today is sort of a basic level of financial control. It's not even really advanced financial control, but without it, everything else starts to crumble because we don't know what's going on and we can't make good decisions. And that ultimately, like Alex Hormozi said, the boring stuff is often what you need to do most. And that is absolutely true for bookkeeping. So what is bookkeeping? First of all, bookkeeping, just to make sure we're all on the same page with the same definition. Bookkeeping is looking at past financial data and categorizing it and putting it into an organized process so that we can make better future decisions. So it doesn't do us any good without the better future decisions piece, but it is historical. It is looking in the rearview mirror, and that we're just gonna have to accept that going in. How to keep books. There are a couple of principles, and I want to talk first about the principles, and then we'll go into everybody's individual situations. Because, for example, Cindy, you're in a little bit of a different spot than some of the other people, but there are easy solutions for all of this. So we'll kind of go in and categorize it for everybody at the end. The first step is to make sure that everything is kept electronically and kept separate. So that includes separate from you personally, separate from buying groceries. All your business stuff should be separated out. Within the separation, there are different levels. So at a minimum, you should have your own business bank account and own business credit card. And then depending on how much you want to separate things out in there. So TJ, for example, multiple business operations under a single LLC. So it's one business, one LLC, one set of books. One option would simply be that would help you in this would be to have separate bank accounts or separate credit cards, maybe a single bank account, but you manage expenses through separate credit cards. So separation and keeping those records electronically so you're not having to deal with paper is critical. And the more you can separate out at the source, and again, that just means not mixing things of different categories. And you can go too far with that, but a basic level of separation will help make everything else downstream much easier and much of a lighter lift. The next, once you have everything separated, the next is to go in and categorize it. And this is where I left it intentionally high level because I assumed we'd have we'd have people in different categories here, or who are approaching this from different angles. So Cindy, this doesn't mean that you have to use a software, and we can talk about your situation specifically again at the end. But for a lot of small business owners, what categorizing looks like is simply exporting transactions from the bank and credit card into like a CSV file and then into Excel. And then from there, you can literally just go through and put next to each one a category, and then you can summarize by category. So like at the most basic level, that's what bookkeeping is. And that's still okay. Like there's nothing wrong with doing it that way. And it's not, especially when you're first getting started, I think it's better to keep things as simple as possible and not incur an extra expense if you don't have the income to support it, and not just not overcomplicate it, not try and understand something new, but just do it well enough that you can see what you spent, what came in, and have it as an ongoing record. So those are the first two steps. Regarding categorizing though, there are basically 5 different high level categories that everything that comes in should be put to. So any money coming in or going out, for that matter, is going to be put into one of these categories. It's either assets, which assets are cash and other things that will make you money. So if someone owes you money, that's an asset. It's a note that you hold. If you have a piece of equipment that's going to make money, that's an asset. And obviously cash and cash equivalents are assets. Liabilities are basically future obligations. So you owe someone money, or you, like, someone has paid you money, but you haven't done the work yet. And so you need to, like, you still have a future obligation. A lot of times that would be recorded as a liability for unearned revenue. And then, those are the main categories. I'll try and keep it simple so we can move quickly through this. And then equity is just, it's net income. It's sort of like the owner's account within the company. And so within equity, anytime you take a payment from the company, like the company has profits and you take some of the cash out of the company as an owner's draw, that would go to, that's an equity event. Anytime you would put money in the company, that's an equity event. And anytime the company might pay, so, sometimes it will happen where a company will pay an expense on your behalf or something where that is not a deductible business expense. And that would also be an equity event. Essentially, it's sort of your account within the company. And those three accounts all three of these get reported on a statement that's called the balance sheet. But that, honestly, for the purposes of this conversation, we're not going to get into the financial statements. That's just kind of background information on this. Those three go to the balance sheet. These other two, income and expenses, are on what's either called an income statement or sometimes it's called a P&L, profit, P&L, profit and loss. So with income, this is some common mistakes we see is if you loan someone money and they're paying you back, sometimes those loan amounts would get those payments in would get classified as income when they're not. They're cash that is lowering a payment, like a loan that you have outstanding. So it's cash that lowers another asset, this note that you're holding. But most everyone knows what income is. Sales, that one is probably the most straightforward. The only note that I would add on income, that another area where we see a lot of people get confused, especially within software accounts, is where you'll send someone an invoice and it gets counted as income. But if when the payment comes in, it doesn't get correctly applied to that invoice, it can get counted a second time as income. So the first invoice is still sitting open, unpaid on your books anyway, and then the cash payment comes in and gets counted as income a second time. So then you have double counted income, and you have still the account receivable from that first invoice on your books. So that's one item to watch out for. But generally speaking, income is pretty straightforward. And then expenses can get broken into multiple categories. And the thing that I wanted you can break all of these down into multiple categories. We've talked about cash, we've talked about cash being an asset. So generally within assets, you'll have, cash and accounts receivable, and I don't know, again, any loans, any fixed assets or equipment. And then I won't go through that with all of it, but with expenses specifically, this is one of the main areas where I think business owners often overcomplicate when they do their own bookkeeping, is that they will get way, way, way too granular and detailed when it comes to expenses, to the point where, we'll see something that looks like there's an expense account that's called printer ink, to that level of detail, something you're going to buy once a year or whenever. you don't need to go that detailed. And if all you did in your bookkeeping was keep it at this high level at first and just say everything is either an asset, a liability, equity, income, or expenses, you're probably going to end up wanting more. But that's better than nothing. It at least tells you the very high level basics. And then from there, I would be very careful about adding new categories, because you end up, the end result of this is that you're going to want something you can look at and digest easily. And if you have, hundreds of accounts, it becomes very difficult to look at and digest. And it's hard to remember what's what, and takes more time to actually categorize everything. So with expenses, there are a few main categories. The first kind of level of categories that you have cost of goods sold or cost of sales. And that just refers to anything that is required directly to pay for the service or good that is being sold. So you buy something, you buy a toaster on Amazon to the Amazon seller, what they paid for the toaster, that's a cost of goods sold. If you, if you purchase, marketing services from a marketing agency, the people who are actually delivering the service to you and the software that they use for that, basically that's what you are paying for. That's a cost of sales for that marketing agency. And it's important to break out expenses into at least these categories: cost of goods sold and overhead. Overhead is basically anything that's not a cost of goods sold, high level, but it's the rent on the building. It's the internal software that they use to, their internal Slack channel, and all those kinds of internal things that you're not paying for, but as the customer, or that don't go directly to serve the customer, but that are necessary to run the business. That's overhead. And it's important to at least break expenses down into these two categories, because it tells you some really important information. It says, for every dollar that I sell, for each incremental dollar that I sell, how much of it, how much am I going to owe to serve that dollar, to either provide the good or to provide the service. And at its most basic level, this is probably the main piece of information that I think small business owners lack, and that limits them on how effective they are in growth, because they don't know, they bring in an extra $1,000 in sales, and they just think that's an extra $1,000. They're not considering what expenses they're going to need to incur in order to actually deliver on that $1,000. And that becomes really, really important as you start to gain any sort of scale. And especially as the expenses, as your company grows beyond you, it's critical to understand that, those two pieces of information: sales and then cost of sales. And then it lets you look at overhead. And that gives you, this is high level. This is the place where you can start to actually analyze your financial information and let it tell you something about your business and how you can, where you should be making decisions. And so if your cost of sales are low, then you can see that your overhead is high, and maybe you're spending too much, maybe you have too much building for the size of company that you are. Maybe, you're spending too much on travel expenses or whatever it is, but it lets you look high level and say, okay, where's our income versus our expenses? And then you can go again into more details from there. But again, I will say one last time, and then I'll leave it alone. I recommend being very careful about getting super detailed on expenses. You want at the end of all this, you want a profit and loss statement that is as simple as possible. So it makes sense to break out travel as its own category, but it doesn't necessarily benefit you to say travel hotels, travel airfare, travel meals. Just call it travel. Move on. You only need one account for that. Same thing with different types of software and whatever. Just one account that covers a whole broad category is good enough to begin with. You can always add more detail later if you need it, but I would start out with as few accounts as possible. So that's categorizing. We've covered keep your records electronic and keep them separate. Second, categorize them. And then third, reconcile them. Reconcile, so for those of you who are using QuickBooks, there's an actual reconciliation module within QuickBooks that is great. and you can use and should use. But even if you're not within QuickBooks, like I'm not going to go into that module specifically, other than to say, if you're using QuickBooks or some other accounting software, you should use it. It's basically just a way of making sure that you have everything in there, that you're not missing any transactions, that you haven't double counted a transaction. And you do that by basically what reconciling really is it's taking the cash balance on your bank statement or the balance on your credit card and saying, what do I, what does the bank statement say versus what I have in my books? That's what reconciling is, high level. And so you don't need a module in QuickBooks to do that. You can do that on your own. You can do that, and you should do that for more accounts than just your cash and your credit card accounts. And so accounts receivable, I mentioned that one as one where oftentimes people will double count income because they're not looking carefully at their accounts receivable to like actually look through what are the invoices that are listed in accounts receivable, and does that match does that match reality? And inventory is another account that should be reconciled, but it's basically just going through your balance sheet accounts and saying, is whatever I have listed as my assets and liabilities, is that accurate in real life? So again, you can get more detailed within accounting software than that, but that's essentially high level what we're doing. We're just making sure that what we have listed as assets and liabilities matches what is really there in actuality. And then we get on to the good stuff. So reviewing results. All of this, these first three steps are all looking in the past, right? And then reviewing results is where we shift and start to look in the future. And the point that I wanted to make on this is simply that most people stop right here. Like this is the limit of where most people reach. They get to the point where accounts are reconciled and they say, great. And even if you have a bookkeeper, that's where most people get to, and that's it. The bookkeeper will send you a report and you say, okay, interesting. And then if you look at it all, you kind of glance at it for a second and move on, but you don't really spend time looking at the numbers. And that is critical because that's where we start. Like, this is where we shift. Everything we've done up to this point is just to set the table for the next couple of steps. So when we're reviewing the results, we want to be reviewing with an eye towards what's coming. So we want to do things like look at our sales numbers and say, well, are sales what we expected them to be? If not, how do we, then we get into making future decisions regarding that. And same thing with expenses, but we can't properly evaluate what's happening if we don't have some expectations set. And so this is not a goal setting topic, and I'm not going to take too far of a detour on that, but you should have written down your sort of expectations, and looking at results should, generally speaking, be looked at against either prior periods. So if this past month looked a certain way, how did the month before that look? And we can use those 2 points of comparison to give us information, or against our goals. So if we have goals set out for this month for sales, and then don't forget also for expenses. So we talked about cost of goods sold. We should be looking at cost of goods sold as a percent of sales. In most service businesses, you never want your cost of goods sold to be more than 50%, because then you're going to have to cover overhead, and then you want obviously to have profit left over at the end. So if nothing else, you would have a sales goal and you would say, and I want to make sure that my cost of goods sold is, maybe 60% in your case. And that at least gives you a benchmark to measure against. And then finally, after we've reviewed the results, then it's time to make decisions. And this is going to lead right into where I'm going next, which is, so how do we do this all in 1 hour a week? And I guess there's one more point that I wanted to make on this, which is I was talking with someone a while ago who ran a very successful business, and he was telling me about how he stopped drinking. And this isn't I don't have an opinion one way or another on this. So I'm not trying to convince anyone of a certain path. It's just, he stopped drinking because he found that he would come home in the evening and he would have a glass of wine and use that to escape whatever stresses or problems he was having in his business throughout the day. And he realized that he was kind of using that to avoid the problems, and he instead needed to kind of lean in and face the problems. So I think that the same thing is done often for entrepreneurs around their numbers, where we have goals set up, we have targets, and there's a lot of stress around those topics. And we sometimes avoid looking at the numbers and avoid sort of sitting down and making ourselves just stare at the reality of the numbers in front of us, when often that's kind of exactly what we need, to sit and look at it and sort of just sit in it for a little bit and say, okay, this is reality, or this was reality last week or last month. And now it's time to make some real decisions about where we go from here. And that's not always going to be a negative thing, but it's the kind of thing that the less often you do it, the more likely there are to be, monsters in that closet. The more we can put daylight on it and actually just stare at it and sit with it and confront it, the more it lets us address things while they're still small and get in those positive habits. So how do we do this in 1 hour a week? There really are two things that I have found. This is completely from my experience, but like I have run 2 businesses that have done over 7 figures a year. And I have done the accounting for all of them on my own. And I've done it in 1 hour a week. And I realize that I am an accountant, so this is sort of my wheelhouse, but I'm also a business owner and I'm just as busy as everyone else. And it's not easy to do. But the 2 secrets that I have found, and I mean, like this first one it's one of those things that it's not easy, but it's simple. You just have to schedule a consistent time every week. You just have to decide, I'm going to do it. And this is the time that I'm going to do it. And this is like a meeting with myself, an appointment with myself. And it's on my calendar and I'm not going to move it. I'm going to treat it with the respect that it's due, just like if it was a recurring meeting with a client. And if you do it every week, it lets this stuff become consistent. And like, it sounds like circular logic, but like the secret to making it take 1 hour a week is to spend 1 hour a week on it. If you do that, then you will avoid having all these clutters of information that you're kind of avoiding that are sitting there that then take a full day to go in and catch up on. And you can't remember something because it was 8 weeks ago. So make time, 1 hour a week, pick a day that you should, this is not a bookkeeping thing, but outside of bookkeeping, you should be having 1 day a week anyway that you just set aside to work on your business, not in your business. And on that day, take 1 hour and make that your finance review hour. And it 100% is doable for 2 reasons. One, you're either small and therefore don't have that many transactions, and you can just export them out of your bank and your credit card accounts and go in and categorize them. Or the other option is you're bigger and then you can afford some software that will help you do that more effectively and efficiently. And the most common one is QuickBooks, but that's by far the only one. And the key with QuickBooks, and that's what I use. And the key with QuickBooks is to use they have a function called rules. And that rules function will let you basically memorize a transaction and say, anytime you see the bank text, I don't know, I'm just picking one, Verizon in the transaction, it gets categorized here and it goes to phone and internet. And that's where it goes. And you can set that to automatically add it in the future. And it's to the point now where I don't have, I'll log in and I'll have just a handful of transactions, even though there are probably hundreds of transactions that are happening in a given week. I don't have to physically lay eyes on more than, 5 or 10, which doesn't take that long to go through. Then that leaves the rest of the hour because we don't spend money in that many different places, generally speaking. And even if it just happens one time and you might spend money again there in a year, you're going to categorize it the same way a year from now as you did right now. So you can set those things up, have them memorized, and then your bookkeeping will largely be done for you on an ongoing basis. And your job is just to come in. You can skip past the first 2 steps here, go straight to just looking over the accounts and reconciling, and then get right into reviewing the results. And that is really, the key to making sure that this is done effectively and quickly, is 1, consistency, and then 2, using the tools to actually create rules and go through that.